Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. President Biden's spending spree is unprecedented. Instead of presiding over a budget that wound down once-in-a-lifetime COVID spending, the president has kept outlays far in excess of pre-pandemic levels. The federal government spent $4.4 trillion in fiscal 2019, yet is poised to distribute $5.8 trillion in fiscal 2023, a whopping 32% increase. By working much of the new red ink into baseline budgets, President Biden has set the stage for annual spending to top $10 trillion. I need to point out that none of this has anything to do with a lack of tax revenue. In dealing with the debt and deficit, President Biden has had the advantage of a 43% increase in federal tax receipts from 2020 to 2022. Income tax collections jumped 64% over that time, and the corporate income tax rate was at a record level. The Congressional Budget Office estimates that the deficit for fiscal 2023 will hit $1.5 trillion, up from $1.38 trillion in 2022. In addition, the CBO projects that trillion-dollar deficits will be the norm thanks to the current president before exceeding $2 trillion in fiscal 2030 through 2033. The administration's fiscal 2024 budget would put the country on the road to surpassing $50 trillion in debt in just a decade. Even the administration's own optimistic numbers predict average deficits of $1.7 trillion over the next 10 years, according at least to the Peter G. Peterson Foundation, a fiscal watchdog. Other than Peterson's, these are the official government numbers, and many, including myself, believe they're highly optimistic based on only a few of the items we will review in this video as outlined here. In our opinion, it will leave America a country you may no longer recognize. I started my professional career in the early 1970s by joining IBM and remember the decade well. My job was the marketing, sales, and installations of quickly evolving computer technology to combat ever-rising costs. Frankly, it was both an exciting yet brutally tough time. Despite 3 recessions in 9 years, double-digit unemployment, and 2 stock market crashes, the mid to late 1990s inflation, it wasn't until the very early 1980s that we witnessed the highest inflation since the end of World War II. By 1981, inflation had reached 15% and interest rates were raised to 20% to combat inflation. Inflation for nearly a decade seemed almost invincible. Then Federal Reserve Chairman Paul Volcker took us all through hell to finally end it. Yet today, most believe inflation is only transitory based on the COVID-19 supply chain shock and will soon be quickly over. In the 1970s, people quickly discovered they no longer had the money to play the market, as they had in the booming 60s, as U.S. household equity as a percentage of financial assets steadily contracted. As I have previously written, I believe we still have a long road ahead in this inflation fight. We're currently entering a disinflationary period as a U.S. recession and global economic slowdown unfolds. I expect inflation, however, to boomerang higher, possibly later this year, but most likely in the first half of next year. Why? First, skilled labor capacity remains very tight. Lots of multi-degreed people, but no usable, employable skills. Secondly, elevated profit margins show increasing signs of remaining sticky, which, given the dynamics, is likely to continue fueling year-on-year effects. Thirdly, China. A worsening economic backdrop only increases the risk that easing in China becomes less restrained. The bulk of the fall in global inflation has been driven by weakness in China, but easing will likely at some point burst through, causing inflation to begin rising again. The currently accepted thinking is that inflation will go down and stay down. Not only would a re-acceleration in inflation pose a risk to assets from a repricing of Fed rate hike expectations, but it would likely catalyze a significant reappraisal of asset pricing so as to incorporate inflation that has become embedded. Term premium, which has remained remarkably becalmed in this inflationary episode, would likely rise as bondholders demand higher compensation for lending money. As well, equity risk premiums will also be higher. Fundamentally, the world's financial markets have become much more volatile. less predictable, and prone to geopolitical and social behavioral shifts. Basically, the world is becoming more risky and volatile. This will be priced into the equity and bond markets in terms of risk premiums and duration risk premia. Additionally, collateral is being repriced, especially rehypothecated collateral, through various forms of financial engineering employing collateral transformations. These are only two of the problems few seem to fully yet grasp. We are already getting less for more, which is what inflation delivers. This is opposed to a freely working capitalist system where you get more for less, and therefore experience a rising standard of living. Standards of living for the lower 60% of the economy are falling. U.S. real disposable personal income fell $1 trillion in 2022, the second largest percentage drop in real disposable income ever, behind only 1932, the worst year of the Great Depression. It appears that central bankers are now targeting 3% inflation as the best possibility. 3% annual inflation for 10 years is a loss of purchasing power of the currency of 34% after what has already been a disastrous inflationary environment. This will be devastating to anyone not having a highly unique, skilled corporate job or government union-protected position in the emerging big government regulatory state or an indispensable trade training. There's nothing positive about rising long-term inflation. It is not just the confirmation of a terrible destruction of real wages and deposit savings, but a huge incentive to maintaining the least efficient and unproductive parts of the economy. Inflation is not just a hidden tax created by bloated government spending financed with artificially created currency. It is also a hidden subsidy to obsolescence and a huge disincentive to innovation and technological transformation. The reality is that a 3% per annum average inflation rate means much higher food, utilities, gas, and all essential purchases. The June inflation reading was particularly concerning because all items except 4 were rising in a month when we should have seen steep declines in most prices. The economy should not be driven by government spending and financial assets, but by a thriving middle class and growing productive investment. The public has become acutely aware of this, with falling expectations and falling real earnings. Increasingly, many Americans can no longer handle the challenges as various strata levels of homeless, as shown here, are now appearing. Daily lineups at food kitchens are seen in almost every town at local churches, senior halls, and various food banks, if you care to notice. Robberies and mass break-ins are so common in big cities that major chains are closing their retail facilities there because of it. Dollar stores are appearing everywhere across America as the choice for daily staples, as even Walmart is being found to be unaffordable for squeezed, inflation-destroyed budgets. The problems are already bad enough, but now we need to talk about what is likely still in front of us. The 3 waves of the 1970s I highlighted earlier are likely to reemerge again, but for similar but slightly different reasons. Some of these differences I've detailed in prior videos, such as this chart on the right from an UnderTheLens video in 2022 entitled The Geopolitics of the Commodity Supercycle. I also encourage you to review this video, which along with others predicted what we are discussing today. However, today we have more actual specifics on how this might unfold. Years of government help to keep the economy alive with absurdly cheap money from central banks has built a Minsky moment powder keg under the economy via unstable markets. An anticipated monetary pause on the back of momentarily encouraging inflation readings may very well be a case of 1 step forward, 2 steps back. Monetary easing is not strengthening the economy. It is weakening the fabric that creates progress only to support an ever-increasing size of government. Many investors want the everything bubble to return, even if it means weaker economic growth, poor productivity, and declining real wages. Inflationary base effects have recently been a huge factor, and that means comparisons will be tougher going forward. The composition of the decline shows volatile categories accounted for the bulk of the drop. That means future inflation relief might not be so linear. The problem is that while job growth may become more limited from here, it won't be for lack of demand, and that can fuel inflation. Demand for labor continues to outstrip supply. Firms are still hiring and raising compensation, while companies find relative ease in passing price increases to customers. So far, it's still full steam ahead for the jobs market, something that won't spell relief for inflation, but is bad news for bond bulls. What is particularly concerning from a guy from the 1970s is that inflation expectations are getting entrenched. At the household level, this could influence savings, investment decisions, along with wage and price-setting behavior, making it harder for the Fed to bring down inflation. The flaw in the current models is the failure to understand the process by which inflation can shift from the supply side to the demand side if inflation persists long enough and high enough. This is a change in the psychology of consumers and plays out in behavioral responses. Neither the psychology nor the behavior is accounted for by standard models. If inflationary psychology takes hold in the general public, it can feed on itself despite recession and declining real wages. The models don't show this, but history does. This is exactly what happened in the 1970s. Inflation can be a very stubborn problem. As I mentioned earlier, despite 3 recessions in 9 years, double-digit unemployment, and 2 stock market crashes, the mid to late 1970s and early 1980s witnessed the highest inflation since the end of World War II. By 1981, however, inflation had reached 15%, and interest rates were forced to be raised to nearly 20% to compound that inflation. The inflation then began from the supply side with the Arab oil embargo of 1973. After the Yom Kippur War, the U.S. suffered a severe recession from 1973 to 1975 with peak unemployment of 9%. The U.S. had another recession in 1980 and a third in 1981-82 in which unemployment hit 10.8%. That recession was the most severe at the time since the Great Depression. The term for this combination of low growth and high inflation is stagflation. Our 2023 thesis paper this year was entitled A Great Stagflation. If you haven't already, I encourage you to read it. Even in periods of economic stress, consumers respond to inflation in ways that make sense. They accelerate purchases because they expect prices to rise further. They use leverage to buy hard assets and stocks because they see these as safe havens against inflation. Retailers raise prices to meet higher wage costs and to maintain margin. The entire process feeds on itself, and this self-help can continue even in recessionary conditions as it did in 1975 and 1981. Stagflation has already emerged. In the UK, CPI inflation in the UK is 8.7%. At the same time, the UK is bordering on a recession with growth of 0.1% in Q4 2022 and Q1 2023, and forecast growth turns negative after that. Stagflation is not just a historical outlier. It is a present-day reality. Are we at that point? Are we in a world where human nature dictates inflationary defensive tactics that feed on themselves despite possible recession and monetary tightening? We're seeing some evidence of this, including a 5-year contract for unionized teachers in New York City that offers back pay and signing bonuses and raises wages by 20%. There's no need to debate whether teachers deserve this raise. The plain fact is they got it. And there are many similar examples emerging as we see in Hollywood with both actors and writers striking together for the first time ever. How long before the pay raises to teachers and others get pushed into more consumer demand and higher retail prices that inflate away the wage gains? The economy could easily begin to resemble 1979, especially considering the rate of deficit spending currently underway, not even closely seen throughout the entire 1970s. There's a price to pay for fiscal excess. Sustained fiscal excess always leads inevitably to 1, rising inflation, 2, currency devaluation, and 3, lowered standards of living. There is an old adage that there is no free lunch. Nowhere is this more evident than in the global currency markets. Poor country economic, fiscal, and monetary policies are meted out through the devaluation of a country's currency. A country's currency over time tracks very closely what is referred to as the twin deficits. This is the addition of the current account and fiscal deficits measured as a percentage of GDP. The U.S. dollar historically has followed longer-term trends of 6 to 10 years. The last trend, which is an uptrend, began in 2011 after the financial crisis and lasted until the high in October of 2022. Meanwhile, the U.S. dollar has held up relatively well until recently because of other fiat currency-based countries having been equally as prolific in their COVID fiscal spending. But that has been changing as Bidenomics pushes even more spending than others, while the U.S. balance of trade begins to fall once again. Additionally, the weaponization of the U.S. dollar as a foreign policy tool has pushed many countries into finding an alternative to the U.S. dollar as its reserve currency. All of this augurs as a recipe for a falling dollar. Since the U.S. imports a vast amount of its consumer goods, a falling dollar means higher prices for those goods that will be needed. That is called inflation. This time it could be very serious inflation when added to an existing inflation problem. This is something that the U.S., with nearly a 70% consumption economy, has never had to contend with. Even in the 70s, the U.S. did not have this level of consumption dependency, nor with a consumer so financially strapped or debt encumbered. The U.S. will have few inflation options to counter a falling dollar. The U.S. dollar, though falling since October 2022, has been in a consolidation pattern since the beginning of this year. We see the consolidation to be what is called a B wave in an ABC corrective pattern, eventually taking us down towards support somewhere in the area of 88 on the DXY, with the leg A equaling leg C shown here. We have a fairly clear head and shoulders formation, with the neckline yet to be confirmed as broken. The measured head and shoulders, shown here dotted in black, also projects a drop to approximately 88. A big part of how inflation takes hold and gains a life of its own is to understand the reaction it receives with changes. The higher and longer inflation persists. First, we need to start with the actual reality of government inflation statistics. Through hedonics, substitutions, imputations, and just outright manipulation, the government has been distorting inflation for years. This chart from ShadowStat illustrates this clearly when we measure inflation as it used to be by the government before the games truly began. The games continue today with more intensity and malfeasance. Shown here is the latest CPI report as issued by the BEA. Inflation is still rising across the board. The exception is energy, and specifically gasoline and fuel. The media touts that inflation is slowing, but not really when you remove the visible falling prices at the pump. This shows you how CPI weakness has been dominated by gasoline falling. The fact is that this fall directly relates to the political decision to sell the country's strategic petroleum reserves. The correlation illustrated here is quite telling. Now that the SPR is approaching empty, we better hope we get good inflation news somewhere else. But that news is really meaningless because we'll have to replace probably our SPR at a much higher price than we sold it at. This likely only means more deficit financing and more inflation. Games like this are just not solutions. Instead of a comprehensive energy strategy for the country, we have effectively crippled our fossil fuel industry and become energy dependent exactly as we were in the 1970s, which crippled the country with energy inflation. I am not trying to pass judgment on whether this is the right road for the U.S. or not. I'm not in the business of politics. However, the current U.S. energy policy clearly is aimed at significant inflationary increases in all forms of energy. It will be seen from transportation to heating to industrial needs to consumer products dependent on them. The solution should not be about making current energy more expensive to justify sustainable energy solutions, but rather to make sustainable solutions less expensive with broader applications. What we are unwittingly doing is effectively institutionalizing inflation, in my opinion. I read every day of the relentless ongoing examples of this. They're ridiculous. Headlines read, Biden administration's next target, your water heater. Next headline. Now the climate gang is coming for our thermostats. Next headline. Gas stoves are a problem. In California, we just witnessed the planned banning of all 2- and 4-stroke utility products like lawnmowers, chainsaws, lawn trimmers, leaf blowers, etc. How is this not going to be inflation with a capital I, or minimally a drain on real disposable income for an already strapped consumer? How are consumers reacting to this? They're reacting exactly as they did in the 1970s, something we have seen very little of since, and that is strikes. Tensions between employees and employers are heating up this summer. Bloomberg reports 650,000 workers threatened to walk off the job and picket in the streets to secure improved benefits, wages, and other conditions amidst the worst inflation storm in a generation. So why is 2023 shaping up to be one of the biggest years of strikes in the U.S. since the 1970s? Well, it didn't happen overnight. 2 years of negative real wage growth has crushed the working poor as they drained their savings and maxed out credit cards to make ends meet. Unionized workers have taken advantage of upcoming contract expirations with companies to bargain for better wages and benefits. Many unions say companies can boost wages because profits have been off the charts. This summer might go down in history as the summer of strikes because 650,000 American workers are threatening to walk off the job imminently. Some have already hit the picket line. Current examples are the combined actors and writers strike in Hollywood is once-in-a-generation event. Unions for United Parcel, UPS, and Detroit's big three automakers are poised to join them in coming weeks if contract negotiations fall through. The New York MTA faces a budget gap of over $900 million per year. Once COVID relief money runs out, huge MTA fare increases are in store. We're told to blame the unions, and the list increases every day. A Bank of America analyst warned a United Auto Workers strike is at 90% odds of happening as union contracts with automakers Ford, General Motors, and Stellantis expire in September. Some logistics experts believe Teamsters will reach a deal with UPS, but that deadline, July 31st, is quickly approaching. Rising wages can be expected to be quickly passed on by their employers. It's called more inflation ahead. How are corporations reacting to inflation and wage pressures? Pretty well exactly as we would expect, and shareholders will be demanding. According to the earnings conference calls, corporations are focused on adoption of AI to control rising wage pressures and margin squeeze. This is code for layoffs. As example, IBM cut hiring of 6,000 new hires solely on expectations for AI benefits. Corporations are rethinking ESG regarding how it is impacting EPS growth and how their stocks lately are taking a beating because of it. There is higher focus on government relations because of increasing regulatory requirements, reporting, and restrictions impacting costs. In many cases, they are seeing more growth opportunities in government contracts as the size of government grows and the private sector is squeezed. Clearly, government is increasingly having a greater role in the strategies and thinking of corporations. This takes away from what makes capitalism work. It can interfere with the highly important creative destruction element of capitalism because of political pressures. It can reduce pressures to reduce costs because government contracts often come with political pressures. If met gets the contract versus solely best price. It also focuses senior management on something called regulatory arbitrage and lobbying to gain competitive regulatory advantage, create barriers to entry against competitors, or influence political policy decisions. This used to be called crony capitalism, but is now increasingly an important element of corporate strategy. All of this reduces pressures on corporations to make the hard choices that deliver more for less for the public. Instead, you get less for more is what inflation is, and we get it as a consequence. So will America soon become an America we don't realize nor like? Higher inflation, despite what the government state, is actually good for it, if done within moderation. It reduces the actual cost of government debt over the longer term. Too much, too fast is the problem with this approach. For a reason we don't have time to discuss, but is readily apparent, the U.S. government seems to be in a huge hurry. Financial repression has been used as a macroprudential monetary policy for decades, where real rates are kept negative along with other measures that achieve the debasement of the debt. Today, the nominal rate of inflation is doing the job. However, financial repression, in our opinion, will soon be forced to migrate to an advanced form that incorporates the use of contingent liabilities to grow needed GDP through government investment guarantees. Higher GDP is needed if we're going to maintain higher inflation rates of 3%. The open question is how the growth size of the U.S. government will evolve. Fascism is an ugly word, but it only means the close working symbiotic relationship between governments and corporations. Today's crony capitalism is operating in some sectors such as defense, healthcare, drugs, and cybersecurity, at least in that realm already. A broader expansion of this through censorship and information control can only be called corporatocracy. In the area of high-tech social media, in recent congressional hearings was shown that we may already have reached that plateau in some corporate sectors. The final level is totalitarianism, with the Great Reset, as outlined by the World Economic Forum, suggests many powerful global elites controlling major global corporations are heavily leaning towards it and actually pushing and funding it. Time will tell if these directions are the America people will oppose or simply allow. Whatever is likely is not going to be an America you may any longer recognize. As I always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it has no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for education and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not necessarily following what has traditionally been the true and tried and accepted approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2023 turn out to be an outstanding investment year for you and your family. I sincerely thank you for listening.